Hi,
This-
welcome to Finance and Coffee. I'm here with Dr. Tal Schwartz. Today we will discuss efficient markets. Tal, when we say efficient market, what do we mean exactly?
Well, when we talk about efficient markets, what that means is that all information is reflected in stock prices. So, market is efficient, everything is already in the price, and there's no way for any investor to do better than whatever the market does. So, you have no edge, you can't beat the market.
So if I cannot beat the market, why try?
It's a good question, and really, you're touching on a paradox where if you can't beat the market, so why would you do research and why would there be any kind of price discovery? But if there isn't any price discovery, then there's not going to the market's not going to be efficient.
It sounds like catch 22 to me. Is there a way out?
Yeah, there is. There is a way out. Basically, the markets have to be a little bit inefficient so that there's incentive for some investors to do the research and actually make the market more efficient for everyone else.
So the markets are not really efficient.
Well, okay, there's a subtlety here. There's actually Professor Fama came up with this definition, the hypothesis, back in the 1960s. And he came up with three types of market efficiency. There's the strong form, which means that all information is in prices. There's the semi strong, which says that only public information is in prices, so which means that if you have private information, you could still make money. And lastly, there's the weak form of market efficiency, which means that only historical prices are in stock prices. So you can't make money by just being a chartist and trying to beat the market by looking for trends. So those are the three forms. And it's been shown also that over time, the market tends to be more or less efficient. So there are periods when it's more efficient most of the time, and then some periods where there's bubbles or busts where the markets tend to be less efficient.
So there are periods of efficiency and periods of inefficiency. How do we know in which period we are and what to do?
So that's a good question. And academics have actually worked on this. Two famous ones are Dick Thaler and Robert Shiller. Both are behavioral economists, and what they've found are that there are different indicators or metrics to tell us where the market is at this moment. The famous one that Robert Shiller came up with is called the CAPE ratio, and it tells us based on the cyclically adjusted P/E ratio where the market is and what the expected future return is. And there's many other indicators as well.
So basically, an investor can create a relative advantage for himself.
Not exactly. Some investors can if they have access to unique information. They have data sources that other investors don't have, or they have abilities to do data processing that's more sophisticated than other investors. Then yeah, they might have an advantage, and they can use that information to trade. But for most investors, they don't have access to that information or to those technologies, and as a result, they should probably not try to beat the market. They should just invest in the market through ETFs or other types of vehicles that are fairly efficient.
So markets are efficient and inefficient at the same time.
That's correct.
I'm glad we sorted that out. Thank you for joining us.
And thank you.